Hey, what's up, guys? This is Jason, host of Fighting Words Financial. Welcome back to the channel. If you've never been here before, please subscribe, like this video, whatever. Let's talk about Block today and the bombshell Hindenburg Research paper that just came out. Now, I've been a fan of Hindenburg Research for quite some time, but when I say fan, I do need to preface this by saying that you really have to understand what it is exactly that they're doing. They aren't working for you, going out and discovering corporate malfeasance for the benefit of the public. Now, they are short sellers. They intend to and they announce and publicize their position before these papers come out, and they intend to profit from the stock going down. Okay, so they are biased in that respect. Now, they have a fairly good track record of reliability when it comes to a lot of these claims. And they have a fairly good track record of reliability when it comes to instigating a real down cycle when it comes to the stock. But people don't always understand what it is they're exactly saying in the reports. And this is one of the ones that is going to be missed because a lot of the content in the report is actually window dressing designed to attract you to read it, to attract you to think negative things about Block, and to get the share price to go down. So there are some very serious concerns with Block. But what I need you to do while we walk through and take a look at this is to set aside your moral outrage over the allegations that they are making against Block. And I can tell you, based on my experience in the financial industry, that nothing that they're talking about is really unique. It is going to be common to all of the financial apps that are out there. It's common to all banks that are out there. They are used for fraud and crime. Okay. I will say that the strategy of going after the unbanked probably lends them to be more susceptible to this type of activity. But let's talk about these allegations here. Block, formerly known as Square, they're a $44 billion market cap company. I think they were close to $73 billion just a year ago. They claim that they've gone through a 2-year investigation and has concluded that Block has systematically taken advantage of the demographic it claims to be helping. Let's talk about that for just a moment. It is a business, and the business of any business is just business, right? They're just there to make money. If you are helping a certain demographic, you are also profiting from that demographic. Whether or not they're taking advantage of that population remains to be seen. I think there's a lot of arguments for that and against that. So the magic behind Block's business has not been disruptive innovation, but rather the company's willingness to facilitate fraud against consumers and the government, avoiding regulation, dress up predatory loans and fees as revolutionary technology, and mislead investors with inflated metrics. So the last item is actually probably the most important, or maybe really the only important point in there. Are they misleading investors with inflated metrics? I'm going to get to that. So they claim to have done dozens of interviews with former employees, which they have a good track record of really producing the evidence here when they're when they make these reports. This was particularly good when they made the report against the EV company a couple of years ago, not Tesla, is Nikola, right? They made the report against Nikola, and they really exposed the fact that Nikola was a company that essentially sold the most expensive piece of artwork ever, and those were the CGI renderings of their Badger truck. They essentially raised $12 billion off of those CGI renderings and never created the working Badger truck. So they were very successful on that one. So they say that their research indicates that Block has wildly overstated its genuine user accounts. I would say that is 100% true. Former employees estimate that 40 to 75% of the accounts they review are fake, involved in fraud, or were additional accounts tied to a single individual. So that is probably true, but that is probably true of every app that is out there, particularly with Venmo as well. There aren't strictly regulations against this. Of course, there are ways of there's things called the know your customer regulations and a couple of other regulations in banking. As long as you're following the know your customer regulations, you are flagging suspicious activity and reporting it, meaning there's a couple of forms you have to file in a lot. And of course, if someone is actually committing fraud through the account, you actually go after that account and remove that account from your platform. You are at the limits of your responsibility, and it's up to law enforcement to kind of do the rest. unless they end up on a system like check systems or something like that. So core to the issue of their report is that Block has embraced one of the traditional, very unbanked segment of a population, and that is criminals. The company's Wild West approach to compliance has made it easy for bad actors to masquerade accounts for identity fraud and other scams, and then extract stolen funds quickly. It's not just that. If you look at the great example of Matt Gaetz, he was engaged in illicit, unclothed activities with potentially minors, and didn't even hide the fact that he was paying for horizontal dancing. Let's put it that way. So even when the users were caught engaging in fraud and other prohibited activities, blacklisted the accounts without banning the user. So tying the user back to an actual identity may actually be kind of a problem, and particularly if someone's using like burner phones or something like that. It may not actually be a useful activity. This is one of the cases where regulation has not caught up to where the technology is at this point. In order to open up a regular bank account, you need to have an address. You need to have a social security number. For some reason, they need to know your occupation and your birth date. Okay. Those are all things that are not necessarily required to open up a Cash App. All you need is a phone number. You could have acquired that phone number from like a Google phone system or something, or from a burner phone, right? So, and when you acquire those other phone numbers, you don't necessarily need to provide all of that identifying information. But this is sort of a black hole of regulation here, or a donut hole in regulation where things have kind of slipped through the cracks. Now, I'm not making excuses for Block. I'm saying that they're probably doing what is required of them under the law and not going any further whatsoever. Even the fact that they know these activities are happening, they are making transaction fees off of these illicit activities as well. And that is the bottom line that their investors are going to care about. And until there is some enforcement action on there, those numbers, meaning the number that they say 51 million active user transactions per month, that is not meaningful to me. What is meaningful to me is the amount of fees that they're generating off of those. It's like a lot of times we see these companies report, so many million products are being used. Great. What are the fees being generated off of those products? That's kind of what really matters. So Jack Dorsey has taken this position, though, that Cash App is for the people who are unbanked, and it's really allowing them access to the financial system, which they wouldn't have. The suggestion in this article is that people who are unbanked are criminals, and I think that is that's not explicitly stated in there, but I think it's suggested fairly heavily, and I think that's radically unfair. There are many people, up to 40 million people in the United States are unbanked, and for a variety of different reasons. Some of them, yes, they owe restitution for crimes or something like that. Some of them owe back child support, but a lot of folks are just regular people who can never maintain the balance necessary in a bank account to avoid fees, right? They also say that Block kind of leaned into this by using rappers and things like that to promote the Cash App in songs. And there's a couple of examples of Block paying a rapper who described paying contract killers through the app, and then the artist was actually arrested for attempted murder later. The app is cited by law enforcement for use in sex trafficking and that sort of thing. I'm going to say that it's no different for Venmo. It's exactly the same sort of restrictions for Venmo. But beyond facilitating payments for criminal activity, the platform has been overrun with scam accounts and fake users. Absolutely. Like I said, though, the same is going to be true with any app that is out there at this point. That's the window dressing that they want you to be attracted to for this article. And even the things that they say about COVID-19 pandemic relief fraud and all that stuff, that is the window dressing that they want you to be attracted to read, and to be outraged about, and to dump your stock. But the really important information here is going to be further down towards the bottom of all this stuff. It is, despite its current rich multiples, Block is facing threats from key competitors like Zelle, Venmo, PayPal, and fast-growing payment solutions from smartphone powerhouses like Apple and Google. Apple has grown Apple Pay activations from 20% in 2017 over 70% in 2022. That's kind of the real threat there. In sum, we think that Block has misled investors on key metrics, embraced predatory offerings, and compliance worst practices in order to fuel growth and profit from the facilitation of fraud against consumers and the government. Their intent wasn't to profit from facilitation of fraud. Their intent was to boost the amount of transactions on their platform, collect fees from that, and they don't really care about fraud unless they're forced to care about it. And that is common throughout the banking and financial industry. There are a lot of practices that are probably not illegal now that will be illegal in the future, but the bank is not responsible for enforcing non-existent laws on processes, on processes that there's no law against. So, and he thinks that Jack Dorsey's built an empire and amassed a $5 billion fortune, professing to care deeply about the demographics. Then he's actually taking advantage of that. Here's the big thing. Top executives have already sold $1 billion in equity on Block's meteoric pandemic rise. Okay. So the other thing that is really, really important here is that Block is no longer profitable. They were not profitable for full year. They look profitable with non-GAAP metrics, but when they use a bunch of different non-GAAP sort of adjustments to bring up their profitability to make it look like they're profitable. So on a purely fundamental basis, even before factoring in the findings of the investigation, they say that they see a downside of between 65 and 75% in Block shares. I don't know if I agree with that number, but I do agree that Block is fundamentally overvalued. Block reported a 1% year-over-year revenue decline and a GAAP loss of $540.7 million in 2022. Analysts have future expectations on profitability, and the company is warned that it may not be profitable. And I checked this morning, and analysts are estimating anywhere from $150 to a $200 million loss for this year. One of the big problems with Block is this right here. It is the stock-based compensation absolutely through the roof. Last year, stock-based compensation was $1.07 billion. They had a $540 million loss. If you cut that stock-based compensation in half, it's still right around what it was in 2021. And it means that the company is now break even or profitable. And that's where I think kind of the big crime is that, but it's definitely misleading the public. If you look through their shareholder letter, which is basically their earnings presentation, and they go through all of their information, they don't actually put GAAP profitability in here until the very end. I was on their call and they really didn't mention that a lot, but they talk about their gross profit. Their gross profit is before this is a non-GAAP measurement of profit. And so when you go back and you add in share-based compensation, when you add in a bunch of other expenses, you are looking at a loss of $540 million for the year. So one of the other big concerns too is the failure of the couple of acquisitions that they've made in the last couple of years as well. The big one being the buy now, pay later thing. I think that was Afterpay, right? Fitch reported that Afterpay delinquencies through March of 2022 had more than doubled to 4.1% from 1.7% in June of 2021. That may be a case of them not doing their due diligence on Afterpay before they made the purchase. I don't believe that it's actually a significant decline in the ability of borrowers to pay. I think that there may have been something else gone down. And total processing volume has gone down by negative 4.8% for the year. So beyond that, Afterpay's losses have seriously accelerated from $184 million in losses in 2021 to $357 million of losses in 2022. Add into that this obsessive concentration on blockchain technologies, their obsessive concentration with blockchain technologies. I think that you're going to see their losses be significantly higher than that $200 million that's being estimated at this point, if we don't see a turnaround in what's going on with the crypto market. So I'm going to get a couple of things here. A couple of questions. If Block or any other company has a hit job on Hindenburg similar and proved wrong, do said company usually sue Hindenburg? No. So Hindenburg has rarely been proven wrong. They've just been proven in many cases that their article is not untrue, but rather misleading when it comes to what they're trying to do. What they're really trying to suggest with this article is not that that Cash App is engaged in fraud. That's well known in the financial industry. It's well known that all of these apps are just rife with fraud at this point, and no one wants to regulate it right now because they don't want to stifle innovation. What Hindenburg is really saying is that Block is massively overvalued. They are unprofitable at this moment. They have been for the last year. They are unprofitable going forward into the future, at least for the foreseeable future. It looks like the growth of Cash App is slowing, and it looks like the growth of Square is slowing as well. There were a couple of things there's probably in the article that are probably true and are going to impact the profitability of Cash App going forward, real quickly. They are using a mechanism of smaller banks that operate regionally to avoid the caps that are on transfer fees. That is probably going to get away. That is probably going to get. They're not going to be able to get away with that for very long. There is likely already a Commerce Department or SEC investigation going on with that. Basically, the government a few years ago put caps on the amount of transfer fees that really large banks could charge. And Block gets around that by separating their business out into like 5 or 6, it may even be even more than that, regional banks. So they stay under those caps and they can charge additional fees, which makes Cash App, just like I say, everything else is for the poor in the United States. Being poor is very expensive in the United States. You pay more for everything, and Cash App is absolutely no different. So the ability of them to sue is pretty difficult because they state pretty clearly, hey, we're a short seller. We're hoping this stock goes down. This is how we researched it, and this is how we've documented it. They can't always come back with, hey, our sources misinformed us, but they're going to have those sources that are kept private, at least until you go to trial. And once you go to trial, those sources are going to be revealed. So there is sort of accountability on the source side in this case. It is rare that a short seller gets sued by the company that does this. The company is going to put out a defense. And Hindenburg has actually given them this great out over the defense, and they're going to defend their platform against the fraud and misuse and criminal allegations when that's not really the point of this. The point of this is Block is saying that they are overvalued because they're not profitable now, and they're not going to be profitable at least for the next year or so. I think maybe quite a bit longer than that. Part of that is the natural sort of maturing of the platform growth is slowing. Transaction fees will probably get limited here in the future, particularly those transfer fees that fund Cash App. That's where they get the majority of their money. They do have some predatory lending schemes that are going on out there. But let's also remember that Square is half of their business. Cash App is half of their business. You're probably looking at a substantial reduction in the amount of fees that they're going to get per transaction on the Cash App side. Their Square side of their business, which is for restaurants, vendors, artists, that sort of thing, to use their hardware and their software and their management platform, that's likely not to be affected. They're also building a pretty healthy business in credit that is being issued by Square. So Square and Toast have these loans that are available through the platform. Once they see that you have enough like transaction volume going through your business, they approach you and say, hey, do you need, $50, $70, $100,000 to expand? If you say yes, they're like, okay, then we're going to take an additional like 5% off of your credit card sales until the loan is paid off, which is, if your business is established, you've got 5% room in your margin to do that, but you need the capital to expand or like add to to build a new bar in your business or to add another bathroom or something like that. It's a pretty good way to finance things because the payment method is built in and you pay back as quickly or as slowly as your profits are impacted, right? So that business is highly profitable, especially now that interest rates have risen. So basically you're borrowing money against your own future business. They provide you to $70,000 in cash and they're charging you 15, 20% interest or whatever the interest rates are. I don't know what those are. But that side of the business is going to grow fairly substantially in the next couple of years as traditional small business lending dries up and we start to see the impact of all these EIDL loans and things like that businesses are having to pay, they're going to be hungry for capital and they're going to have to pay the price for that. That's where we're probably going to see that business grow. So in terms of the Cash App side of the business, they probably reached their high point. They may continue to grow, they may not. There's probably going to be a reckoning on, but this is going to take a while because there are laws and regulations that have to be passed, and they're going to be debated in Congress, or there's at least going to be agency meetings to do this. But there's going to be a reckoning when it comes to the cap on cash transfer fees. That is going to be a reckoning, and we are going to see that revenue decline for Cash App, and that is the majority of the revenue. So the cash credit cards offers, the lending offers, all that stuff that are considered, possibly predatory. I don't know. If you're unbanked, you only have business through Cash App. If I were in charge of managing credit for that business, I would make you pay a premium for that credit. You don't have a bank account that we could go off after. You don't have any other assets that could support that. You're talking about unsecured loans to folks with the least amount of financial history with the lowest credit ratings. So I would need to actually see what they think predatory lending is to that particular demographic. If you've ever done peer-to-peer lending and you look at the interest rate difference between like A-rated lenders and F-rated lenders, it's pretty large, man. If you got bad credit, you're paying 26% on unsecured loan versus 5% for someone who's A-rated credit. So that's kind of the thing here. But the point I really wanted to make with this article is that go ahead and read through it, but set aside your moral outrage over the things that are happening on the platform and think about whether or not they are just taking a transaction fee from a transfer fee from money that is changing hands, which is what they're in the business of doing. And it is not up to them to play detective and figure out whether or not this is used for drug money. It could be used for someone selling, handmade soaps out of their house or something like that. You don't know based on the transaction happening what it's actually for, right? So the big thing is that Block is saying that this company used this exploitation of illicit businesses to sell billions of dollars of stock during the pandemic. Once again, that's a difficult case to make as far as whether or not that was right or wrong. The big story in here is declining profits. There is not a future profits ahead. The decline in transfer fees is likely to come with enforcement action, and the fact that there was going to be a crackdown at some point on the entire industry, that cash transfer industry, when it comes to fraud and things like that. So that's kind of my main points with this. They talk about competition as well. That's a large point that I'm not going to address in depth here. I'm just going to say that when Apple gets involved in something, they generally win. Their market, the people that buy Apple products, are essentially a cult, and they're going to do whatever Apple introduces. They're going to embrace it wholeheartedly. Anything that could be anything from an EV to a watch to a phone to new apps, whatever it's going to be. Anyway, that's my opinion on that. And my opinion is, like I said, separate the sensational, morally outraging stuff from what they're really saying. They're saying the stock is overvalued and it doesn't have much of a future, at least in the near term. Okay. How come nobody talks about Squarespace? Anthony, that is a company that I just have not looked into. I haven't looked into that for a while, and I'm not familiar with their business metrics at this point. So, So you were thinking about shorting it at this point. Yeah. If Hindenburg is wrong, do they ever get sued? So they did a report on, I don't know if it was Hindenburg or another firm that did a report on Lemonade. I believe that Lemonade sued whoever made that report, but really it didn't result in much because all they were really saying was Lemonade was overvalued as well, that they aren't really a technology company, that they're at best just an insurance company, and that getting into renter's insurance wasn't really as disruptive as everyone said it was. And I actually agreed with that report. At the time, they provide a lot more products than they do. They provided a lot more products than just renters insurance, kind of like SoFi. They were put in this box of someone that just did renters insurance, like SoFi was put in the box of only doing student loans. and that was kind of the reputation. When the reality is they have a fairly substantial suite of insurance products. Rental insurance is just the easy way in. It's cheap. It really rarely gets claimed because any damage to a unit that's rented, for the most part, if it isn't personal belongings, gets paid for by the apartment building themselves. So you're really looking at insuring, personal belongings in case of fire, in case of not flood, but in case of fire, in case of like a tree falling through the house or getting robbed or something like that. Insurance is dirt cheap. And like I said, claims are really, really low on that because most people, if there's just a few items are stolen, they're not going to file a claim. So it was a way to get into a highly profitable section of the business at a very cheap price point where the barrier to entry was really low. And it works to a degree, but since then they've struggled to get into the more expensive end and in the higher profit end of the insurance business. So I think that one was completely justified. But whoever made that report, and I just don't remember if it was Hindenburg or this other group that I don't remember, but they ended up getting sued, but nothing happened with the case. But anyway, let me know what you guys think about Block. I hope I covered everything that I wanted to cover on there. But the numbers that I would avoid looking at are the Cash App monthly transaction actives. The amount of transactions that are occurring is not as important. It's the dollar amount that's important. This is what is really important. And we're seeing a roughly 13% increase year over year. And that is a significant decline in transactions year over year. 123% jump, 2019 to 2020, 2020, 2021 is 54%. And now it's at 13%. Okay. The amount of monthly transacting actives just doesn't impress me that much because it could be microtransactions. It's really about the dollar amount, the amount of money that's going in and out. That's where they're generating their money. So hold on a second here. Tangible price to tangible book value versus peers. Hold on a second. This is the thing. The increasing reliance on non-GAAP adjustments. Block transformed its $540 million GAAP loss for 2022 into a $613 million non-GAAP profit by adjusting out costs, including over $1 billion in 2022 share-based compensation. And I think that was like a 78% increase over the prior year, which I think is ridiculous. And that's all according to information based on their report. So by adjusting out stock-based compensation, and there were a few other things that they adjusted out, now they have a non-GAAP profit, which I think is an unfair metric for them to be promoting. It provides a false sense of profitability. And, so Jack Dorsey described in Block's business as having a purpose of economic empowerment. Very nice to say. But if you're in business, you're there to profit over that. You're there to profit on top of that purpose. I think that's something we should never forget, that all of these businesses that claim to have a mission, their real mission on top of that is to make money. That is just the nature of business. And we shouldn't be surprised when incentives to make money are misaligned with their mission statement. That's clearly the case with the SoFi lawsuit as well. If their mission is to really empower those high net worth but underserved clients, why would they really be suing to restart student loan payments? I don't think this pause should last forever. I am in favor of partial forgiveness, especially for people that are making under that $125,000 limit or $150,000 limit, or for families that are making under $125,000 limit, and individuals making under that $75,000 limit. Actually, it's $150,000. Sorry, but I do think that some sort of suit should have gone through to force the government to start collecting those fees again. I just wish it hadn't have been SoFi. It's really bad press. And I realize that they have a responsibility to their shareholders, but that responsibility to the shareholders is running counter to responsibility they have to the demographic that they're claiming that they want to help. So that is, I had kind of a singular focus today on what I wanted to cover in terms of Block. They go through a few more interesting things, like putting this up where police arrest 5 members of a drug trafficking organization called Cash App. It's very, very sensational. But what does it actually have to do with the value of the stock? It could have been called Venmo. It could have been called SoFi Cash. It could have been called Moneyline, or whatever their app is called. I forget. But the fact that people are using this app and are engaged in criminal activities is actually in a way kind of meaningless to the overall statement that they are trying to make here. So, and going into all of this being promoted by rappers, and he said there's over 30 songs named Cash App. People feel that's valuable and provides so much utility to them, and they want to sing about it and spread it in their way. He paid them to do that, guys. It's a really good way of marketing. But including all of this in the report, like I said, is just a way to get you morally outraged about what only Cash App is supposed to be doing when it's a known fact that all of them are doing about it. So, Anthony Walker, you should be really looking at Squareface, my friend, and forget about Square. So I have held Square in the past. I recently sold some of my stocks because I'm buying yet another business, guys. And Square was one of those stocks that I sold. I did take a bit of a loss on that, but like I said, I have an opportunity to get into the ground floor of a business that I'm very excited about. And Square was one of those positions that I sacrificed. So thankfully, that was a good week and a half before this report came out. I didn't have any adult, advanced knowledge of this. I didn't have any, there's no being superpowered or anything like that. It was just pure dumb luck. And I said, I set aside some cash in order to invest in a new business. And that is that. But I have been down on that stock for quite some time. I've been selling call options that repeatedly expire without being exercised. So it did lower my loss a little bit on that. I was able to generate some income from it. But that is over for right now, and I'll move on. But I will take a look at Squarespace. You do make some good suggestions on here whenever you do show up, Anthony, and you always make some controversial comments too that are more insightful than combative. And even though you like to be combative, that's cool too. But yeah, any other questions, or should I move on to talking about what's going on with the Fed right now? And I think that the most important thing with what's going on in the Fed is, okay, wow, all right. So that was a wild session. I haven't looked at the market in a couple hours. It was way up and way down. But I think the most important thing that you should gain out of what's going on with the Fed right now is that the Fed is able to take their foot off the gas pedal in terms of raising interest to make borrowing very expensive. And that's because the market is doing the work for them. Meaning that bond prices on the corporate end are dropping because people are starting to price in risk, and that is higher yield. Necessarily about what's going on with bonds, the behavior of those two started to diverge a little bit, and spreads, corporate bonds, all levels are starting to widen versus government bonds. People are actually starting to extend the risk of default for some companies. And even if the company doesn't look like they're ever going to default on their bonds, their 10-year, 20-year, 30-year bonds, that possibility has not been priced into corporate bonds for a very, very long time, for 13 or 14 years, because interest rates on risk-free have been so that it brought down the interest rates on important, is because it's not simply the Federal Reserve raising interest rates that causes your rates to borrow money to go up, is actually a floating market rate. So it's based on whatever the risk-free money from the Fed is, the risk-free money on a treasury is, but there is a market rate associated with that. And those yields are starting to rise because investors who fund those loans are starting to demand more and more for the amount of risk that they're taking, because they have to combat the risk of a recession, you losing your job, your credit risk, as well as inflation risk over time. It's not clear that we're actually going to return to 2% inflation. 2% inflation as a target is actually lower than historical inflation has been over the last 30 years. Prior to 2020, historical inflation averaged about 2.34%. That 0.34% over a 30-year period makes a pretty large difference, right? And that is all what's being repriced into the market right now. Okay. Let me a little bit of time. And let's see. What is your trigger to sell out of stocks in a company when you're down? I'm down on a stock by 35%. And Okay, so my trigger to sell a stock doesn't have much to do with the stock price in the moment. It really has to do with whether or not I think that the company has a future of hitting profitability and maintaining profit growth over a long period of time. So, for example, I don't own pretty much anything that's in the top 10, 15, 20 of holdings on any sort of like managed mutual fund, or even the top fundings by market cap on an ETF or something like that. I generally don't hold those as largely because they've reached they're no longer like exponential growth stocks, and they're going to grow more in a linear fashion, more like 7 to 10% per year. And that it doesn't justify the risk that I'm going to take with an individual stock. Okay. So if I'm going to buy an individual stock, it's going to be something that's smaller, has more room for explosive growth. They're expanding business lines. We're looking at compound growth in the double digits over time. And when I say double digits, I would really prefer that to be in the 20% range. I would, or at least owning as an individual, I can just be satisfied to hold this ETF. If the rate is 10% or lower, I'm much happier own it by owning an individual stock. I don't want to limit my upside potential in return for use. No matter what upside potential is for any stock, you're down for 100%. Has to keep in mind. Out of all the stocks that were on the Dow Jones in AT&T was on it back in the 30s. But that is the most common 1% for the entire stock market, and you say not as what is the average return, but what is the most common return over the lifetime of the stock for any individual stock. The most common return by far is over a long period ETFs, because you want to take limited risks with your individual stock because you're always assuming that risk of 100% loss. See here. So I happen to really in the time period for a couple of different reasons. We'll likely see a decline in the growth of apartment rent increases. We will not see rents go backwards. That's not an increase, but apartment REITs are one of the great ways to keep up with inflation, especially the ones that are really well diversified, like Avalon Bay and Mid America Apartments. Geographies diversified. Mid America Apartments is mostly in the Midwest, and Avalon across the United States. But Avalon Bay kind of specializes in the higher end apartments, and they are a really good inflation adjusted income stream. That as inflation really hits hard, you see rents rise. In that case, you see property values rise. They are going to have a little bit more trouble expanding now because their cost of capital is higher. I would consider a stock really soon after possibly raising their dividend. They'll make a secondary offering of stock, maybe sometime this year. So in terms of upcoming, we're not going to see a ton of secondaries, but a REIT might actually do this year. What I would avoid like the plague or REITs that specialize in offices. I'm not talking about companies like REITs. That's a little bit of a different story because they do specialize in really do a lot with Home Depot. They do a lot with grocery stores. They do a lot with Lowe's and these other like really large retailers that their business actually looks fairly solid for years to come. Like I know in it and a 6-year lease on it. And I'm thinking to myself, I don't know how much longer Jiffy Lube is going to be a concern. It's not that that all internal car are going to go away. Is that Jiffy Lube going to be able to pay their rent on that building on 50% of their business? Can they do it on 75% of their business? If 25% of the cars 10 years from now are electric, can that particularly Jiffy Lube survive? I don't think that they can. So there's a lot of retail space that is poisonous. There's almost all office space, I think, is poisonous to a degree, unless it's very specifically healthcare related. I think it's going to be poisonous. But the big thing that I think is going to do very, very well, and has done very well for me in terms of generating income and capital return since I've been invested in them, and that has been residential real estate REITs like Avalon Bay, Mid America Apartments. I'm not recommending that you run out and buy these. You got to do your own research. One of the big stumbling blocks with any of the residential guys is the fact that a lot of them don't actually own that much property. What they have is a lot of mortgage debt, right? A lot of mortgage security. And those are the things that I would avoid, largely because, like, what's you have with duration risk where you're off on that investment is so far in the did, but just rises and declines. And can expect from is there are going to be non-performing assets in those here in the near future. The value of those is going to have to be marked down, and some of these mortgage-backed securities, like mortgage-backed securities in 2008, most of them were bought for between 20 and 33 cents on the dollar. The folks that bought them ended up doing fairly well, even if there were significant amounts of defaults in those less than credit quality tranches in there. But the people who took the risk and bought them did fairly well. They just had to wait a really long time to do that. If you're an apartment company that is going to try and go out and borrow money, like an apartment REIT, borrow money to buy a new property or build a new property in order to get the rents from those and pass them on to the REIT holders, it's going to be a lot harder to do that if you have a bunch of mortgage-backed securities on your balance sheet and you have unrealized losses, meaning you can't liquidate them for more than what you paid them for. And that's going to limit their ability to go out and get capital and expand. And this is how REITs live and die, is that there is an element of capital gain in there, but they pass on 90% of their earnings to shareholders as distributions. They go out through secondary offerings and dilution, or by go out and get more properties, right? The going out and getting more money, all of their stock prices have cratered, not that low, but they've all gone down significantly. So they're going to raise less money than the secondary offering. And the cost of capital is much higher. And a lot of these companies that are focused on mortgage-backed securities are going to have unrealized losses on their balance sheets. And it's going to make it more difficult to get money, basically. So most financial YouTubers would be really involved, especially after these guys getting sued. If you are, and I think that Meet Kevin is doing the exact wrong thing by talking about his legal case, but I will say one thing: he's not wrong about following advice that you hear on the internet. Don't take my word for it. I am a certified financial planner, but I don't know anything about your individual financial situation. And any decision you make has to be tailored to your investment time horizon, and try and trade based on what you see on the internet is trying to go out and trade based on what you see on the internet is out. These stocks are close to a bottom. Market, it's very close to a bottom. I think that bottom probably hits sometime in July. Typically, what happens when the Federal Reserve stops raising interest rates is we actually see a market decline after the Federal Reserve stops to raise interest rates, and it continues through 1, 2, or 3 interest rate declines, and then it really takes off, right? But that's the point where people really start to see the market slow down. Everyone's talking about recession. But the fundamentals of the markets have already started to turn in that time period. That's when fear really peaks, is after the Fed stops raising interest rates, when they're getting ready to, or in the middle of those first 2 to 3 interest rate declines. That's generally when we hit that market bottom, and we see kind of acceleration after that. I don't think that we can say with any definitive, with anything definitive, that we're going to see a market bottom before the end of June, because that political fight with with the debt ceiling has to happen. And if you guys have seen the budget proposals that are out there, the budget proposal is they're ridiculous. They're so far at extremes right now, and it's all done for negotiation purposes. There's one extreme out there on the left, one extreme out there on the right, and it's going to create a lot of uncertainty, which means decline. I predicted the market would get close, would get down to probably 3,800 again. It came close to that either last week or the week before that. I'm kind of losing track of time here, and it'll get close to that again before June 30th or so. I hope it doesn't go much below that, but I don't think it will go much below that. But we'll see. The time when I would start to look at saying, "Hey, things are hitting bottom." Now, granted, let me be honest with you guys. I do not time my trades. Mostly what I do is dollar cost averaging. As I get money in, I invest it. I don't save it up, and then dump it in all at the same time. Market timing, I may make it feel really good once or twice, but there's always going to be the time periods when you mistime things. The better approach is to invest a similar amount of money each month, what you can afford. When prices are higher, you're going to buy fewer shares. When prices are lower, you're going to buy more shares of whatever you're investing in. And it's going to bring the average cost of your shares down pretty low. I will say that when things get really low, things look really, really bad, and fear spikes the highest, I do tend to invest a little bit more, but there are limits to that. All right, guys, I'm actually getting some important phone calls right now that I wasn't expecting. So I'm actually going to hop off this live stream real fast. Thank you for tuning in for what we're saying. Hold on a second. This is a good one. What do you think about Coinbase being served with a Wells known as SEC? Big problem or not? So I think the SEC is really starting to test their enforcement capability when it comes to regulations concerning Coinbase and banking. That's really what's happening right here. And I think that they're trying to really find out what's going on, rather than saying, we already have the goods on you and we're going to sue the crap out of you and find the crap out of you. It's really exploratory at this point. So Coinbase so far has been looked at sort of the honest player when it comes to the crypto industry, and they've been looked at way since the beginning. They've made almost every attempt that they could make to be in compliance with U.S. bank laws. This is one of the reasons why, like people that are really into crypto really hate Coinbase. It's because it ties the identity of that wallet holder back to the individual fairly strictly, in compliance with most U.S. bank laws. I'm not going to say all, but it's all of them that are really applicable, and they're even compliant with some that don't necessarily apply to them based on law. So, but anyway, I covered some really complex topics here, like bond markets, mortgage-backed securities, unrealized losses. I cover things that have to do with accounting and non-GAAP adjustments to income. The most important part of what was going on with that short report, like I said, set your moral outrage over all of the criminal accusations. None of those are unique. None of those were unknown, and it's going on with every financial institution. The thing you need to focus on is whether or not you think that the adjustments to income, which those aren't secret either, it's just how it's presented and the sort of indications that they're giving about the health of their company, that is probably misleading at this point. Block is going to lose money this year, and they're probably going to lose money next year as well, which would translate to Square being overvalued. They're not trying to put Square out of business. They shorted the stock. They're pointing out that it's overvalued. They're going to profit from that. All right. All right, guys. Thank you very much. And if you're watching this on a rerun, thank you very much for doing that as well. Once again, I'm out of time. I got to return this phone call I just got. I will see you guys on Monday, and I'll probably have another video out next week as well. Thank you.